Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Monday, 21st of June. My name is Carl Capilingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we recap all of the big moves in markets from last week and then look to the week ahead. We'll do that after we talk about the ThinkMarkets difference, which is substantial, $8 flat rate trades, your own holder identification number, unlimited phone support, no hidden platform or subscription fees, and a world-class trading application. 5 fantastic reasons why your next ASX share trade should be with ThinkMarkets. And if you're new to the ThinkMarkets family, get signed up trading before June 30. Your first 5 trades are on us. So that's 10 great reasons. The agenda for today, as suggested before, is to break down all of the big market moves from last week. And there were many, mind you. We'll have a crypto update as well. We'll check out the key macroeconomic data, which caused many of those moves. See where the value lies in the Australian market, if there is any value. Check out what the charts say and then have a look to the week ahead. Let's kick off with our crypto update. And if you are a fan of the crypto space, you have no doubt heard about this impending death cross on Bitcoin. Sounds pretty bad. It occurs when the 50-period moving average crosses below the 200-period moving average and typically signifies the end of a bull phase. Of course, the opposite is when the 50-period moving average crosses above the 200-period moving average, and that signifies the beginning of a bull phase. Not what we've got here. There's the cross that occurred over the weekend. Typically, when this cross occurs, on Bitcoin at least, it has signified in the past a continued downward move in prices. There are often short-term rallies after the death cross, but more generally, prices tend to go lower. So it is a fairly bearish indicator for Bitcoin and therefore really for the broader crypto space. Look, it's not a technical tool that I personally use because 50 periods, 200 periods, they are quite lagging. The fact that simple moving averages as well makes them very, very slow. What I do use, which is on screen, are faster moving averages in the short term. And they told me that the Bitcoin trend was changing back in late April, and then also price action. This was a key breakdown here through support. That's telling me that we are moving into an equilibrium market. I signaled that many, many weeks ago from the previous demand side market. And then we can talk about interaction with longer term trends and how we move from there. But the 50-period and 200-period moving averages are widely used, I guess, by many people in the market, generally non-technical people. It's probably the only technical tool they have. So it's worth understanding when it occurs and therefore what it might mean. Getting back to my technicals, we are very much stuck in a trading range here beneath the long-term trend zone, which tends to support prices on the way up. However, when we slice through that long-term zone, it can often resist prices. We often see prices struggle to get back above that long-term trend zone. And really until we do, and this zone is it's going to tick down as time goes on, and more than likely coincide with some of these static levels of resistance that are in the market, areas where we clearly have seen supply negatively impact prices. And look, the bad news is that I would expect price weakness while we're beneath this zone. But the good news is that the silver lining here is that if we can close back above this zone, I think we get a really clear-cut indication that we're moving back into a demand-side market. Okay, so until then, I do agree with the death cross that prices probably will remain under pressure. We're well supported around the 31,100 level, and then really 30,000 as a key psychological level will come into play as well. But in the meantime, there's really not a lot to do. So Bitcoin is an avoid here until we see that close above. If you're a short trader, you would be waiting for really a close below, say, 30,000 to then take us to the next level, which is probably 20,000. Moving on to Ethereum now, which is the second largest crypto by market cap. It's also in a short-term downtrend, but doing slightly better than Bitcoin in terms of its long-term uptrend, which is very much still in place, and we're still trading above it. Apart from this last little interaction, we have seen prices bounce back above that zone. This one is a question mark, because we've hit it with a bit of a dull thud and we haven't been able to push back off it. I think the most sensible thing to do with Ethereum is to back this short-term trend and therefore avoid any further investment in this crypto. If we were to break above 26.96, it starts to get a little bit more interesting. Unfortunately, if we break decisively really below this current level and then again below some of these lower support levels around 1800, I think it starts to look pretty dicey for a move. It could be as bad as back into the low 1000s. So this is very much an avoid for me for the time being. Looking at the other major here, which is Cardano, we have, I believe, moved out of this demand side market into this equilibrium market. And once again, the question is, where do we go from there? Do we sort of break into this supply side market like we did with Bitcoin, or do we maybe continue in the equilibrium market for a period of time before maybe then resuming the demand side? I think just with that explanation alone, there's enough uncertainty there to also avoid this one until we can get some clearer signals that demand is returning to the market. In the meantime, we may continue to see some pressure into this long-term dynamic support zone. I wish I had better news for you crypto traders, but unfortunately I don't make the charts, I just read them. Let's switch gears and head over to Aussie shares now. A pretty good week, up 0.9%, but looking within the market, a number of sectors went in opposite directions. Discretionary stocks, nice, up 4%. Healthcare, up 4.5%. Information technology, up 7.5%. Reasonable gains in financials, telecoms, utilities and staples as well. Heading in the other direction, gold down 6% as gold prices tumbled during the week. Materials down 3% on a similar plunge in base metals prices. Energy down nearly 2%. I think getting caught up with that sort of risk-off commodities move, even though energy prices were higher during the week. Let's head over to the chart and we can see a very strong long-term uptrend for the Australian market. Compare this chart to some of the cryptocurrency charts we saw earlier, a very well-established short-term uptrend as well. The price action looks great. We've got higher peaks, higher troughs in the system. We've got some wonderful candles, predominantly white candles over the last month or so. So the bull market here is well entrenched. We are clearly in a demand side market, and therefore I think if we do get some pullbacks, and we're going to have a pullback today, you do look to buy those dips. And for me, I prefer to allocate capital on those short-term pullbacks within the long-term trends rather than paying top dollar on those price extensions. So watch out this week for some potential buying opportunities, I think is the message there for Aussie shares. Having a look around the region, just Shanghai suffering as the rest of Asia was pretty flat. We'll talk about some of the reasons for that fall in Shanghai when we get to the economic data. The US markets were quite interesting, 3.5% down on the Dow Jones, but it is a very narrow index, 30 biggest US stocks, and maybe some stock-specific problems on that one. If you look to the broader market, not down as much, but still a nasty fall, 2% for the week. Then the NASDAQ, which is the tech heavy index, was only down 0.3%. So you can see there's a bit of confusion going on here amongst equity investors. Plenty of confusion in the volatility index. That was up 32%. Now that is a monster rise for any single week. And it is concerning to see volatility spike like that. It was as a result of some of that economic data, which again, we'll talk about in a second. Europe was down as well in response to those US falls. Having a look at the S&P 500 chart, yes, we've still got that long-term uptrend in place. That's a big check. The short-term trend is very much up, but I'm a little bit concerned by the fact that we did slice straight through that trend on Friday and we closed on the lows of Friday's candle. So that's typically a precursor to further price weakness. The fact that we've gotten through some of those key support levels would lead me to believe that maybe we're going to come down and test somewhere around that 4,100 level, just assuming a slight uptrend from 4056. But moves like this are not uncommon. We've seen them before. So I think the message there is, look, don't panic at this stage, at least. We're still very much in this bull market phase. And I think you do need to be looking to buy pullbacks rather than making any rash moves on your portfolio. Having a look at the NASDAQ, I mean, this is another reason why I think you need to stay the course. I mean, tech stocks still look very strong, and we might even see a little bit of a pullback this week, but we're going to be supported at that short-term dynamic trend zone, and then the long-term trend is still very much up. Look, the NASDAQ is probably more in an equilibrium phase than the S&P 500, but I do note that we are compressing towards the top end of that zone, and typically, not saying all the time, but historically, typically, we do see in these sorts of patterns a break through the upside of that zone. So it's very interesting to see that we've got the S&P 500 and NASDAQ stocks moving slightly in different directions. Unlike base metals, which during the week pretty much moved in one direction, and that was down. Big fall on copper, 8.5% on the London Metals Exchange, and 9% in the US dollar contract on COMEX. Nickel down nearly 6.5%, tin down 6%, zinc down nearly 7%. You can see it was a bit of a bloodbath there on those commodities. We saw a really big spike in the US dollar. Most of these commodities are priced in US dollars, and that therefore undermines the pricing of these contracts. But also there are some concerns about economic growth going forward based upon some of the data that we saw during the week. Much of that data influenced gold prices as well. Gold prices down nearly 6%. Silver hit harder, down 7.5%. Look at platinum, down nearly 11%. We'll have a look at the gold price shortly. For now, the copper price, and it's looking like a pretty clear-cut short-term downtrend with those lower peaks and troughs in place. The short-term moving averages have definitively turned to the downside, and therefore we need to rely now on support from these long-term moving averages, this long-term uptrend zone, to stave off a move into an equilibrium and potentially therefore down the track a supply-side market. There is a fair bit of demand, I believe, to be found down here at previous static levels, and we'll be watching very closely to see what sort of a response we get. Dr. Copper, as it's referred to, is one of those great proxies for economic growth going forward. So on the face of it, this chart suggests that maybe economic growth might not be as good down the track as some were expecting, but also I think it's in response to some of the moves by Chinese regulators to clamp down on what they saw as rampant speculation in some of these commodities markets. So there's a few things going on here, and we'll just have to wait and see how that test of that support level turns out. Encouragingly, the other key industrial metal, which is iron ore, has held up really well. And if you go back a couple of slides, we saw actually steel prices improve for the week. So that is encouraging. Looking at the gold price, not encouraging if you are a gold bug, because we did see a really sharp fall in gold prices during the week. I think setting 1916 as a major swing high, unfortunately, with 1959 and 2073. And, the overall trend in those major swing highs is down. Look, having said that, this was an encouraging rally through here. Look, it didn't shoot the lights out, but, it ticks a number of boxes in terms of, getting the short-term trend back up, getting it back above the long-term trend. I don't like to see us slice back through that zone. There is some support here at 1750, but my expectation based upon these lower swing highs is that we may well see something more like this with a test into those support levels around about 1676. Then a quick bounce back and a move back into this short bull phase that we experienced through March to June. Having a look at the energy complex, generally higher for the crude products, down on natural gas. The Australian dollar down nearly 3%. Now that is a big move for a currency. 3% in 1 week, massive move. 2% on the euro, 2% on the pound sterling, and that was in response to a big rally in the US dollar, as evidenced there by a near 2% pop in the US dollar index. Bonds look fairly steady on the face of it, but it was a wild week, as we'll see when we get to those charts. Part of the reason why it was a wild week for Australian bonds was due to a massive beat for Australian employment data for the month of May. 115,000 jobs created. That was way ahead of the 30,000 jobs the market was expecting, and well up from April's fall of just over 30,000 jobs. The important thing is that the vast majority of those jobs were full-time positions, and that speaks to the confidence within the Australian economy right now when you're adding full-time positions. We saw the unemployment rate drop to below 5.5%, and that is basically now back at pre-COVID levels, and that was despite an increase in the participation rate. So that set of employment data about as good as you can get. Australian economy looking pretty hot right now. We saw some less than dovish comments out from Philip Lowe, Reserve Bank Governor, and that shot our bond yields higher. It was encouraging to see stocks hold up in the face of that though, but again, today we know we're down on the back of those US moves. Looking at some of the Chinese data, and the trend is what's most important here. We're continuing to see a bit of a contraction here in some of the pace of growth. But I do note we're still in double digits on fixed asset investment, high single digits on industrial production. And when we get to the next slide, we'll see still in double digits on retail sales. Yes, they were worse than expected. Yes, they're moderating, and that does also speak to some of those declines in some of those commodities that we saw during the week. But I prefer to take the glasses half full approach and say this is more of a managed move in the Chinese economy by regulators to remove some of that froth and therefore increase the sustainability of the Chinese economic recovery. And I think that's a good thing for us in the long term, and also for commodity prices. Chinese unemployment a little bit worse than expected, but same as last time. Having a look at some of the US data, and we saw a really weak print on US retail sales, a fall of 1.3%. That was worse than expected and well down on the previous month's gain. Core retail sales, stripping out volatile components like energy and transport, was still down about 0.7%. Most of the moves there, I think, mainly COVID related. There was a sharp slowdown in motor vehicle sales, which got a boost, obviously, during the pandemic as people moved away from public transport. Having a look at the producer price index. So this is inflation at a wholesale level, and we saw that come in worse than expected, hotter than expected, at an increase of 0.7% for the month. That was worse than economists' expectations of 0.5%, but in line with the previous month. It takes us to about a 6.6% annual rate if you have a look at the last 12 months, and that is the highest we've seen for over 10 years, or at least since this particular data series began. The biggest gains came from grains, which were up about 25%, non-ferrous metals, which off the top of my head were up about 17%. These are rising input costs here, which then producers have to decide whether they're going to pass into the CPI, which is the consumer price inflation, and that's the one that the Fed is watching more closely. So potentially what we've seen so far is weaker than expected economic data and elevated inflation. Not a great mix. Another weaker than expected print here on the weekly jobless claims, rising to 412,000 for last week compared to the market expecting only 360,000, and up on the previous week as well. The overall trend in the continuing claims remains slightly down, however. As interesting as that data was, it all paled into comparison to the data on screen now, which is the FOMC, the Federal Open Markets Committee dot plot. So this is the reserve. Each dot represents a board member and where they think the official US interest rate is going to be over, say, 2021, 2022, 2023, and then in the longer run. Now, this is the March meeting here. This is the most recent update we had until the June meeting, which occurred Wednesday last week. And prior to the last meeting, we were not expecting a lift-off, as it's quite popularly called in markets now, a lift-off in rates until, quote-unquote, the longer run. As a result of June's meeting, the dots have changed, and now we're expecting a potential lift-off in rates as soon as 2023. Now, in the past, when we've seen this sort of shift in thinking at the Fed, stocks have responded poorly. It's often referred to as the taper tantrum of 2013, and there is a fear that we have a similar sort of taper tantrum now in 2021. Also spooking the markets is the fact that some of the dots for 2022 started to show up at higher rates as well. On the back of the dot plot and our own local employment data, we saw a big spike up in Australian bond yields midweek, moving up the better part of 20 basis points. So when you think about the Reserve Bank, rising or cutting rates, they typically do it by a quarter of a basis point. We saw the better part of an interest rate hike during the week as far as what the market is expecting. Look, it did moderate a little bit on Friday, and it will probably come down this week as US rates receded on Friday quite sharply. And the other thing I would suggest before you start getting too alarmed by that spike is that the general trend is still lower. And whilst we're sort of in this range here, we're okay. We don't want to see it break below that range, because when yields fall like that, it would indicate that there is a problem with global economic growth. Coupled with some of those moves in base metals, that would be concerning. We don't want to see it go up here, because it would mean that inflation is way too hot. Interest rates have to go up to combat that. So I would suggest share investors take that move in their stride and continue to back this case that the inflation that we're probably going to see is transitory, not something that's going to be more sinister and long lasting. If it was, then these rates would have really spiked up and kept going up during the week. It's not what we saw in the US either. We saw the spike here. This is the dot plot spike. It hobbled gold as well, because it shows a more hawkish Fed. And then perversely, Thursday and Friday, the talk was all about, well, if the Fed is more hawkish, and if they're more likely to start the taper sooner, get rates up sooner, we're less likely to see inflation. And therefore, rates have to head down. So you had this weird situation where we've got the prospect of higher rates, but then also those higher rates limiting the rate of inflation, which then facilitates lower yields. Look, once again, anything sort of around this level here is okay for markets. We don't want to see it get too far below, say, 130, because again, it would indicate slowing economic growth, and we certainly don't want to get it back up here. But it does demonstrate why we saw that huge spike in volatility during the week on the VIX. Having a look at the value in the Australian market, or if there is value, it's not particularly cheap at the moment with a 1-year forward P of 18. Typically 15 is considered to be fair value, but we are cheaper than the rest of the world by quite a margin. So that should be helpful for Aussie shares going forward. Looking at where the value lies in the Australian share market, the material sector is still the cheapest, unfortunately probably going to get a little bit cheaper with those falling commodity prices. Then we're looking at energy as the next cheapest, then financials, then property trusts, and then they fall away from there. Tech stocks, obviously, those PEs have risen with the rising share price, which indicates that shares didn't necessarily go up because earnings are expected to increase. There was something else at play there, and that is more likely to do with those falling bond yields towards the end of the week, rather than any meaningful pickup in earnings. So that's something to consider before you chase those tech shares. Having a look at some of the technical analysis insights now, what we're checking here is the market breadth or participation in this bull market. How many stocks are trading above their 5-period, 10-period, 1 month, 21 periods in a trading month, 3 months, 6 months, all the way out to 1 year moving averages. The more stocks trading above their moving averages, the more stocks are experiencing excess demand, and therefore demonstrating to us that the interest in the market is broad-based and therefore sustainable. We did see a deterioration in the breadth during the week in those shorter timeframes, but largely unchanged over the timeframes, so that's pretty encouraging. We are definitely also well up from where we were about a month ago. The 1 week and the all-time measures are the same, because the all-time spike in market breadth was made a week ago. Still pretty encouraging is what I would suggest there, but monitoring that dip. Here we have the ASX sector performance and where we are in terms of our technical trends in the short term and long term. If you're looking to invest into a pullback, I'd be going for sectors that are showing ups at the moment. They have the strongest trends. So certainly discretionary is a place that I'd be happy to look. I don't mind energy. Long-term trend is just neutral at this stage, but I'm seeing some signs of a pickup there. I think financials still look very good. I think you need to continue to avoid gold, and also based upon some of the analysis we did earlier on. Healthcare's a big tick for me. Information technology, I'm going to give that a tick. I think you can follow the newfound momentum in that sector. Materials, I would just avoid at this point in time. Let's see how that pullback in commodity prices plays out. But otherwise, the long-term trend is still up. Happy to look at property trusts, staples, telecoms, and utilities is still an avoid for me at this stage. Okay, looking to the week ahead, the big data out today is going to be Australian retail sales. We are expecting a little bit of a fall from the prior month, but still a gain there of 0.4%. Then we're going to get our flash PMI readings during the week. That'll be on Wednesday morning, and then pretty quiet into the end of the week. Looking to the rest of the world, we do have some ECB speeches tonight. We do get a speech from Federal Reserve Chairman Jerome Powell on Thursday morning, our time. That will be very closely watched by markets. Then we get some manufacturing data from Europe and the US. Durable goods orders, that is a big data release. I'll be watching that very closely, as I will be watching very closely for personal income, personal spending, and then the core PCE price index, which is the Federal Reserve's preferred measure of inflation. We're expecting a small moderation there from 0.7% to 0.6%. So potentially a big week in data, a big week in market moves. Stay in touch with all of those in the market news section of our website. You can also catch my updates, all the Think Market updates, on Twitter. In terms of upcoming events, we do have a few webinars upcoming, and one this week which you'll need to go to the webinar section of the website to register for, and that'll be Ask the Experts tomorrow, where you get to bring your portfolio to the table. Tune in, ask me about any stock you like in real time, or it could be crypto, or it could be a commodity or an index, and I'll give you a quick technical and fundamental. Of course, make sure you register for the other ones as well. That's it for me today. The disclaimer before I leave you says that everything we've covered is general in nature. Also, we are a regulated Australian broker. We do have some products that could see you lose more than your deposits. So it's important you do read this disclaimer carefully. If you have any questions, please give us a call. It has been a pleasure chatting with you this morning. All the best for your trading. Until we catch up again. Bye-bye for now.